Alright, so today I thought we'd take a look at a company that I've had my eye on for quite some time now, and that company is Intel. And just as they've released their Q2 earnings report, their share price has crashed. So now I think is a good time as any to go and have a look to see if we can go bargain hunting. Or on the other hand, maybe Intel is like trying to catch a falling knife. If you're new to my channel, well, welcome, and my videos are about investments that anyone in the world can make. And out of all the different places to invest your money in the world, well, I think the stock market is one of the best. But let me remind you of the harsh reality of stock market investing. 90% of people lose money. And I think that's just incredible that every year there are just new people that pile their money into the stock market thinking this is where they're going to make their riches. But unfortunately, more often than not, they don't make anything. So my goal is to help as many people as possible actually understand what it is they're investing in when they're looking at putting money into the stock market. And I want to help people understand that it is not gambling when you're investing in the stock market, you are long-term investing. And there is a difference. Okay, now let's get into today's company and we're going to investigate Intel. So Intel is a big mature company that has been around for more than 50 years now. Now, just for simplicity, Intel are best known for manufacturing motherboards, microprocessors, and graphics cards for PCs. But more recently, they've been transitioning into cloud and network infrastructure. And they're actually right in the middle of this transition into this new space. So even though they're in the middle of this transition, well, the results actually so far have been very impressive. And this new sector that they're in, well, it's actually now making up about half of all of Intel's revenue. Now, on their core business, which is the microchips manufacturing, well, they have some strong competition from AMD and Taiwan Semiconductors. Now, look, these are big companies, but they're really not on the same level as Intel regarding size. So if we were just to look at the revenue over the past 12 months for these three companies, we have Intel at $78 billion, Taiwan Semiconductors at $39 billion, and then AMD down at $7 billion. So as you can see, Intel is nearly double Taiwan Semiconductors. And they're more than 10 times as big as AMD. So Intel are transitioning mostly because the PC growth days are over. So the company over the past handful of years has been focusing on the cloud and networking infrastructure side of their business because this is what they think is going to be the growth driver for the next few years. And so far, I don't think they're wrong. The world of data is getting more important every year, and Intel has already made some big strides in the space. So if they can successfully work themselves into this area, well, I do think there's strong growth in the future. Well, on the personal computing side of things, well, commercial PCs, they're not going away anytime soon. And although it seems boring and there's not a lot of growth here, it is still a necessary part of offices throughout the world. And we still all have laptops and PCs. I have a laptop, I'm sure you have a laptop as well. So demand for these are going to remain because for every 3 to 5 years, we're going to have to replace them. So look, I'm fully aware that the rocket ship growth potential of the PC market is long gone, but Intel is still a beneficiary of the PC market as a whole. Firstly, before we get into all the negative stuff, I just want to highlight that Intel had actually great results. And here are the latest numbers from Intel. Now, revenue is up 20% year on year to $19.7 billion. Now, just for reference, that's nearly 3 times as much as AMD makes in a year. And their earnings per share, well, is also up 16% year on year to $1.23 per share. And both these figures, well, it beat analyst estimates as well. So you might be wondering, like I am, why did the share price get hammered? Well, there are 2 reasons why this happened. Firstly, gross margins fell from 59% down to 53%. So I don't think that is a good sign. And the second reason that the share price tanked, well, is actually because Intel were going to release a 7 nanometer microchip. It's a new product for the marketplace, but they had issues with their manufacturing processes and they've had to delay that for 6 months now. So a 6-month delay on launching a new product, is it really that bad? Why did the share price do that? And just because of this news, well, Intel's share price fell 15% in one day. Well, yes, I do think it is a concern. Anytime that the barrier for entry for competition has been reduced, well, that's not good for the business. So personally, I actually don't think the share price falling that dramatically was an overreaction. It was justified. But what we need to do is we need to take a step back and look at the bigger picture here. The company is transitioning into stronger growth revenue streams. And those revenue streams of cloud and network infrastructure, well, they've already shown very good signs of solid growth. So the 6-month delay on the new 7 nanometer chip, well, it's not going to wipe Intel out. Look, it is a setback, but in the grand scheme of things, it's really only a minor setback. So there are going to be some personal changes in the management team at Intel as well, because they weren't able to deliver this new product on time, but that's not necessarily a bad thing or a good thing, time will tell. But it is clear that Intel have some things to work on and that they are facing some strong headwinds in the near-term future. So the question still remains that are they a financially strong company and are they at a bargain price? Now, there are three key areas to the health of any business. We want to see whether they can manage their debt, are they growing, and are they a well-managed company? And like always, just sit back and don't worry about the terminology, just try to get a feel for what's happening. So it is really important to look at the company's debt because if the business was to completely stop for some unforeseen reason, like, I don't know, the manufacturing plant burnt down or something crazy like that happened, well, we want to make sure that they're going to be okay, and with low debt, they will be. So to see if the business can handle its debt, I went through the debt to equity ratio and current ratio of the business. And for Intel, the debt to equity is looking good at about 0.5. I want to see under 0.7. So slightly trending upwards is a bit of a concern, but it is still well below a good level. Now I'm looking for above a 1.5 normally here, and Intel is nearly at 1.7. So they are handling their debt well, and they don't have any short-term concerns regarding debt. Now, growth is something that might be a slight issue in the near-term future, both because of their manufacturing processing problems that they've been having and the delay of that new product. But what we can do is go and have a look at how their performance has been so far. So in the finances, to check for growth, I look at the book value per share, the earnings per share, and the operating cash. So this is the book value per share, and this is definitely the growth we wanted to see. It is consistent and improving. Now this is the earnings per share, and as you can see, there has been a jump in the past few years. Another good sign as the company has been performing very well. So even though the earnings report is a bit of a hiccup, they have shown really good growth in the past. So we are going to give them a tick here. Now, of course, we can't just go and meet the management team and sit in on one of their meetings. Even though I would love to do that, well, in the financials, there are some telltale signs that the management team are making some good decisions. So I check the return on equity, free cash flow, cash on hand, and I check if they're paying a dividend. So this is the return on equity graph, and I want to see this above a 15 as it shows management are improving the value for the shareholders. So Intel's being above a 20 is great and what I wanted to see. This is Intel's free cash flow, and more good signs here from Intel as free cash flow is growing. So this is Intel's cash in the bank, and it is growing, which is a really good sign considering they are investing into other things so much. This means that the company, well, yes, it's investing in their future and new projects, but it's not more than they can handle. They are preparing for the longer term by building up cash in the bank. And as a bonus, they are paying a dividend of about 2.6%. So as we've seen, there are more impressive findings here, and we can definitely give them a tick for being a well-managed company. So from the financial history point of view, well, I can't fault Intel. They can handle their debt, they have been growing, and they look like they're a well-managed company. But the problem is still these short-term headwinds that they're facing. But at the right price, I think this is a very interesting company. But because of these short-term little problems, I'm going to want a really strong margin of safety. So let's go take a look at what the intrinsic value suggests. And if you want a copy of the same intrinsic value calculator I'm about to use for this demonstration, well, there is a link in the description below. Okay, so the first thing we're going to input into the intrinsic value calculator are the growth estimates. Now, the best place to find this, I think, is just by simply going to Yahoo Finance and going to where the analysis tab is on the top right of the page here. Scrolling down, and we go to all the way down to growth estimates down the bottom here. And it says the next 5 years per annum about 8.6%. It shows you the past 5 years as well, which has been growing at 19%. Now, look, the analysts, they can't predict the future. We're only using this as a guide. I would actually also like to go and do some research into what other analysts are thinking as well, and maybe put some sort of average together. But for simplicity, let's just use 8%. So I'm going to use 8% for the next 5 years. Now, let's say it just slows a little after that for years 6 to 10. So we'll put it at 7%. Now, I want a good margin of safety here because there are these short-term headwinds that the company is facing. Normally, I put this at 20%, but let's go straight to 22% because that gives me a really good margin of safety. Now, the multiple I could sell it for after 10 years. Now, I've put that as 12. Historically, I went and had a look at what Intel's historical PE ratio is. So historically, it's around about 14, 15. But again, let's be conservative. Let's put it at 12. So the operating cash flow minus maintenance CapEx. Now, to find the operating cash flow, what you do is you go into, well, you can just Google this and find it anywhere. I'm in Morningstar and I've just typed in Intel and it gives me the operating cash flow here, this number of nearly 38. This is the trailing 12 months, about 38 billion. Then I go and find I minus the maintenance capex. Now, if that maintenance capex number is too hard to find, you can just use the free cash flow. Here it is here. A lot of people recommend doing this. There are a few schools of thought on this. I go this into detail in the comments, but I like to do the operating cash flow minus maintenance capex, but free cash flow is right here. So it's pretty easy to just grab that number. Anyway, it came to 24 billion. Now, the shares outstanding now, it's pretty easy to find. That was in the same place. So it's got 4.351 billion. There it is here. This is all in millions. 24,000 millions, so 24 billion. And 4 billion. Okay, and it says the price I want to buy it at is $44.80. Now, that would give me a pretty good margin of safety, and the growth rates are pretty reasonable, I would say. So the current share price, let's go have a quick look, is $48.15. Okay, so we're actually really close. About $45 is where I'd be very interested in buying at, and the current share price is $48. So this is telling me that when we get to about $45, there's a really good investment here if we're willing to take it. Now, what I've also done is I've just gone down and put in some even more conservative numbers. So I've used 7% and 6% for the growth rates. I kept my margin of safety at 22%. The multiple, let's put it down to 10 to be even more conservative. And we get a number I want to buy it at about $40. $40 a share. So $40 a share would be a really good price to be buying Intel at. 45 is good. 40 would be amazing. So the price being $48 right now, we're really not that far away. So do I think Intel is a good company to invest in? Okay, so let's put all of this together. Now on the negative side, we've got Intel. Well, they're not an explosive growth company. They have matured and they're stable. Competition has a short-term advantage because of the delays Intel are facing with their new microchip. They are transitioning into a different area, and this will create issues. Will they be able to deliver? But the competitive advantage they have is their size. They can just outspend AMD. Even though everyone was negative about the earnings report, they strongly beat on revenue and earnings per share. Their financials look really good historically, but yes, the short term might be a little bit rough. And finally, they are very close to a good buy price with a really good margin of safety. So in my opinion, I actually think this is a classic case of an investment that Peter Lynch, Monish Pabrai, and Warren Buffett would probably all like. I mean, they're a company that's had a few negative things happen to them recently, and they've really just turned into this boring company. And because of these reasons, well, the share prices, of course, suffered, and this presents itself an opportunity to invest. Now, this is all my opinion, but I think fundamentally the company is far better than the share price is representing. And I won't be worried to invest if I can get the price that I want because I'll be getting a really good margin of safety. Now, I'd love to hear your thoughts on Intel as an investment because I know a lot of people out there are going to think that this is really not a good idea. And hit subscribe if you enjoyed this analysis, and I will see you in the next video.